Okay. So some of you might have taken a class on money and banking, and the material that we will see here is more or less what you might have studied. But if you've not seen that material, no problem, because the assumption here is that we are starting from the basics. In fact, this is so basic that you are going to be asked, what is the function of money? All right, so what do we use money for? I'm going to simply read this out and give minor explanation. The reason I'm doing this is this might show up as a multiple choice question, so you should know that broadly speaking there are 4 functions of money. One is a means of payment, which means you can settle debt. If I owe you 1,000 rupees, I actually use money then, so that's an obligation, right? I owe you. Now how can I settle that obligation? By giving you a 1,000 rupee note. So one function of money is a means of settling a debt. The next is medium of exchange. So because of money, we can say that I am giving you a service and you are giving me money. If we didn't have money, what would happen? Then we would say, okay, I am giving you a service. You give me, somebody gives me some oranges, somebody gives me apples, somebody gives me a laptop computer, somebody gives me a tablet. And we'd have a very difficult time determining, okay, how many oranges is my service worth, right? Or how many apples is my service worth? So in the days bygone, when there was barter trade, obviously it was very inefficient, because how do you figure out how many apples are equal to how many bananas and so on? So money allows us to have a very simple medium of exchange, makes life more efficient. It's a nice unit of account, which means that it's an agreed measure for stating price of goods and services. Because of money, we can then say this laptop is worth 60,000 rupees, this tablet is worth whatever, 5,000 rupees and so on. So it's a unit of account, which means we can use money to say how much things are worth. And it is a store of value. So if you have money, you have 20,000 rupees today, you can actually keep those 20,000 rupees and hopefully that value is maintained, assuming little or no inflation. Okay, so you can hold money and buy goods and services later. So these are the 4 functions of money, nothing too elaborate, just need to know this from a classic multiple choice question can be made out of this material. Now, slightly more involved, but what are the components of money? And if you've not seen this before, then listen to this very carefully. So what is money? Money consists of currency, which is notes and coins held by individuals and businesses, and deposits at banks and other depository institutions. I'll use banks, depository institutions are just banks, thrifts, and so on. Fundamentally, it's like banks. What seems to be missing here? A critical point is money, physical money. So notes at a bank are not part of money. All right. So did you understand that point? So if you have at a given bank, if you have, let's make a very simple society. So let's say that this is our community, and in this community, we are all individuals, and then there is a given bank. So the definition of money would be all the money that is in our pockets is money. But if we have deposited some money at a bank, our deposit or our account over there, if our account says that Saad has 5,000 rupees at the bank, that deposit is considered money. But if the bank happens to have 100,000 rupees in cash, that is not considered part of money. And you are going to see why. Okay. If you didn't understand that fully, just take it as a given and you'll understand the logic shortly. The other aspect is money can be broken up into M1 and M2. So what does M1 mean? So M1 is one definition of money. This is very liquid money. So M1 means all currency which is held by individuals, traveler's checks that are held by individuals, and your checking deposit. So if I have 10,000 rupees in my pocket and I have a 50,000 rupee account at XYZ bank, then the total amount of money because of me is the 10 plus 50. Okay, and if this represents the whole, this classroom represents the entire community, then what will be the total M1? It will be all the currency that we are holding, plus each one of us, let's say, has a bank account. We look at our deposit and then add everything. Why is the money at the bank not counted? So if we have a deposit, so let's say each one of us has a deposit of 10,000 rupees. 20 people over here, 10,000 times 20 will be the amount of money plus the cash that we hold. If we also added the physical cash at the bank, won't that be double counted? Do you get what I'm saying? So if we are counting our deposit at the bank as money, then we can't also count the physical cash at the bank as money. Either it should be either or. If we do both, then it would be double counted. So the definition of M1 is the currency in our hands, travelers' checks, which are like currency, and our checking deposits. Currency at banks and checking deposits owned by the US government. So this is a small minor point. We can ignore this for now. This is the major point. So the currency at the bank is not part of M1. Okay, so M1 is a very liquid definition of money. What is M2? M2 is a broader definition of money, which includes M1. So everything that is in M1 is also in M2. Plus, this will also include time deposits, saving deposits. So what are time deposits, saving deposits? This is money in a time deposit would be some money that you have locked in for, say, 2 years. Okay, so that's a time deposit. A saving deposit would be a savings account where you are getting a return and so on. So slightly less liquid, but still fairly liquid. When you have money in a time deposit, with a minor penalty, you can often withdraw that money. Also, money markets. Does everybody know what money markets are? So money markets should be, so if you put your money in a money market account, what happens with your money? Your money is used to buy T-bills and other very short-term, very safe and liquid investments. So even money markets are considered part of M2. Why is it? Because when you put your money in a money market fund, can you easily get it back? Actually, if you put your money in a money market account, within a day or two, if you want to redeem or get your money back, you can. So it's not like investing in your uncle's business, right? So if you put your money in a money market, it's reasonably liquid. Within a day or two, if you want your money, you can get it back. And mutual funds also are considered M2. What's a mutual fund? You'll see this in a lot more detail later, but lots of people pooled their money together and give it to a mutual fund such as Atlas funds or MCB funds or Mizan funds or so on. So all that is happening is your money is being used to buy stocks, bonds, and so on. If you want your money back, can you get your money back easily? Yeah, as in if you put your money in, say, MCB funds and you decide to get your money back, you just call your advisor or your banker at MCB and within 2 days you can get your money back. So it's not as liquid as immediate cash, but it's 2 days still fairly liquid. So all these things together are, so M1 plus these slightly less liquid than cash but still fairly liquid investments are all considered M2. Okay, here is another critical point from an exam perspective, is a check. So you write me a check and I put that in my drawer over here. Does that add to, is that considered money? The answer is it's not considered money. Why? Because if you've just written a check to me, and it's sitting in my drawer, does your deposit change? Your deposit account, that's not changed. So the money is still sitting in your deposit account. Has my account, so my deposit, has it gone up yet? It's not gone up. So the check is simply a means of transferring money and it's not considered part of money. Obviously, when the money goes away from your account and into my account, then obviously your deposit will go down and my deposit will go up. What about credit cards? So credit cards are also just a means of exchanging money. So money goes from one bank into another bank. So that's also a credit card in of itself is not considered money. What? Where do you see checking deposits? So basically, checking accounts, deposit accounts, these are just minor terminology. Do you know what a checking account is? So this is your checking account is when you open up. In Pakistan, it's generally called current account. Okay, so in America, it's called checking account. When you open an account and you say, I don't want any interest, I just want to be able to put in money, take out money anytime. Yeah, so that's a simple account that you go open. You can think of that as a checking account. And the deposit in your checking account is when you go open a checking account, you put in a deposit, you put in some money. So that's the deposit. Very basic banking. Okay. Checks, this is just reinforcing the last point, and it's being reinforced because this is a high probability question on your exam. Checks are a method of transferring money but are not money. Deposits in a checking account are money. Okay, so in our definition of money, a deposit is part of money, but a check is not considered part of money. Credit cards act as an ID when a promise is made to pay at a later date, and a credit card, just because I have a credit card sitting with me, doesn't mean that that credit card in of itself is money. Depository institutions, basic concept. So the most fundamental sort of, what does depository institution mean? Fundamental idea is it's a place where you go deposit money, and then that money is used to make loans and so on. What's the most basic kind of a depository institution that all of us here are familiar with? It's a commercial bank. They receive deposits from people and they make loans. What are their assets? Their assets might be liquid assets, so their assets might be the cash that they have. When a bank receives money and buys treasury bills out of it, is that an asset? So the treasury bill is an asset for the bank because they have used money and bought treasury bills. The cash sitting at a bank, is that an asset for a bank? That's an asset. Any loans that a bank makes, the loan that a bank makes is an asset for the bank. So what are the liabilities for a bank? The deposit is a liability. So the deposits that we make, that is a liability for the bank because the bank is under obligation to give that money back to us when we want. So these are the assets and the liabilities are the deposits. All right. In the US, there is also this concept of thrift institutions, and over the last decade, the sort of the difference between thrift institutions and banks is becoming more and more blurred. But thrift institutions, essentially, you can think of as banks. The subtle difference is that there are different flavors of thrift institutions. You can have saving and loans. So this is often referred to S&Ls, saving banks, credit unions. I don't think this is hugely important, just a one-liner on each. Savings and loan association would basically receive deposits and then they would make various kinds of loans, home loans, car loans, etc., mostly to consumers and less so to corporations, which is the distinction between them and commercial banks. Savings banks are similar, except most of the loans they make are for home purchases. And then credit unions are also like banks, but a credit union would be a sort of a bank that only caters to a particular population. So you might have in the city of Detroit, you might have a credit union for employees of General Motors. So the credit union would be basically serving a given community but offering banking services. So essentially they are all like banks. And why is a money market mutual fund also considered a depository institution? You can actually think of it in simple terms here using Pakistani examples. You can think of Mizan funds or MCB funds, UBL funds. Many of these institutions, if you have some extra money, so if you have extra money that you don't need on a day-to-day basis, then is it logical for it just to be sitting in a checking account? Probably not. Let's say you don't have the time and energy to go invest it somewhere. So a logical thing to do would be to put that money into MCB funds. So MCB funds will take that money and buy stocks, bonds, whatever based on your risk profile, which we'll talk about later. But essentially your funds have then gone and been invested somewhere. So that's an example of a money market mutual fund. And if you didn't fully get that, don't worry. When we do alternative investments later, we will study mutual funds in a lot more detail. Again, continuing with the basics of banking, what are the economic functions of depository institutions? And if you think this term is too long, you can essentially just think of banks. The most basic function is that they create liquidity. They create liquidity by borrowing short and lending long. What does this mean? Fundamental concept in banking, when a bank borrows, who is the bank borrowing from? It's borrowing from depositors. What does borrow short mean? When a bank borrows, it is borrowing short, which means that any one of us deposits money in a bank, we have the right, generally speaking, to go withdraw our money at any time. So the bank, in a sense, is borrowing from us, but it's borrowing short term. Why? Because the depositor can go any day and say, okay, give me my money back. So the bank is borrowing short. But when the bank lends, if the bank lends to a textile mill operator, then the bank will lend long. What does this mean? The bank can't lend and say, okay, 3 weeks later, give me my money back. Right? So when a bank lends, then the bank will have a contract, and the contract will say, okay, this is a loan that is payable over the next 5 years or 6 years or whatever. So when a bank is lending, it's lending long. Okay. So that is this lending long, and by doing so, it is creating liquidity. So it is taking money from all of us. It is hoping that we won't come and get our money back, and then it is using some logic to then take a percentage of those deposits and making long-term loans. And how do they make money? They make money by paying a very low rate, on average, say 4% to 5% to depositors, and making 18, 19% or whatever. I'm just picking these numbers, much higher rate so when it lends money. And very, very loosely speaking, the difference between these two rates is called the spread. And Pakistan has one of the highest banking spreads in the world. Okay. Minimize the cost of obtaining funds. So the second function is that if a businessman wants money, without banks, what would he have to do? He would have to go find all individuals and borrow a little from him and a little from him and a little from her and so on. Okay, is that expensive? That's time consuming and expensive. But with a bank, the entire money is sitting in one institution which has been collected from the individuals, and now that money is being lent out. So for a businessman, the cost of obtaining funds, at least in theory, is lower. He doesn't have to go hunt for money. So that's number 2. Number 3 is minimized costs of monitoring borrowers. So banks monitor borrowers so households don't need to. Now, as you notice in all this, banks are also referred to sometimes as financial intermediaries. So in essence, what is happening is you have your bank in the middle. You have people like us who are depositors. So we are putting our money all of us are putting our money in the bank. So then the bank has all this money, and this money is then being loaned out to, so these are your factory owners. So these are being lent out for investments. Now, what I talked about in point 2 is where these factory owners are borrowing money from the bank. With point 3, minimize cost of monitoring borrowers. Now, when a bank takes money from a bunch of depositors and lends it out to business 1, okay, the advantage is when a bank lends to business 1, the bank performs the function. Anybody who is associated with the credit department at a bank will know that whenever a bank makes a loan, it does a lot of analysis to figure out whether this business 1 is worthy of the loan. So there's this whole credit, one of the largest departments in the bank is the credit department. What's the credit department doing? It's figuring out whether it can initiate a loan or not. Now, in a sense, the bank is doing that once for this company, and then all these people, their money is essentially being loaned out to them. If you didn't have a bank and people had to invest in all these companies, then each one of these people individually would have to determine, is this guy good enough? Can I lend money to him? Should I not lend money to him? And so on. Alright. So this is why the cost of monitoring borrowers is lowered, because the bank is just doing it once for everybody. And then what does this pooled default risk of individual loans mean? So now depositors put their money in a bank. This money is then being lent out to several companies, company 1, company 2, company 3, and so on. If, let's say, company 3 defaults, the point is that no one depositor takes the whole hit for that. So the risk of a given company defaulting is basically spread out across all depositors. If you did not have a bank and this person, then what would an individual do? An individual would lend a little money to lots of companies, or is it more likely that he would be doing due diligence on one company and lending to that? Chances are that without the financial intermediary, a given individual would just say lend his money to one factory. Now, if that factory defaults, this guy, so if this factory defaults, the individual who lent to that factory is facing the whole, he basically loses his whole money. So his risk is not diversified. Banks, at least in theory, if they do their risk management correct, are diversifying the risk by, basically this is called pool the default risk of individual loans. The next concept you need to understand is that of financial innovation. What does financial innovation mean? In the world of finance, this term means the financial innovation is the process of developing new financial products. Okay, what are new financial products? I'm going to get to them shortly. But before we get to different types of financial products, what is the fundamental objective of financial innovation? Essentially, a bank is not a charity. Either it wants to lower its costs. How do banks lower costs? By lowering their cost of deposits, or they want to increase their return. Okay, so either they want to cut their expenses or they want to increase their revenue. So generally they do financial innovation for one of these two things, and both of these will help drive up profits. Okay, what are examples now of financial innovation, and what is it that creates financial innovation? One is an economic environment. So I'll give you an example from the curriculum. In the US at least, a lot of people borrow money from banks to buy a home. Okay. In the 80s, do you think people who are borrowing money from the banks to buy a home, are they hoping for low interest rates or high rates? Obviously, people who are borrowing money want low rates. In the 1980s, the interest rates in the US were very high, but they were expected to go down. That's one point. Another point is that up till the 80s, when people went and borrowed money from a bank, the loans were generally based on fixed rate payments. So if interest rate was 10%, then people would simply go to the bank and get a loan at 10%, which meant that for the next 30 years they are paying back at 10%. So what do you think would happen to this borrowing market if interest rates were very high in the 80s? Very few people would borrow. Is that good for banks or bad for banks? So that was bad for banks. So what financial innovation did they do? They came up with this concept of an adjustable rate mortgage. A mortgage is essentially a home loan. So what's an adjustable rate mortgage? Banks would then tell their customers that, look, interest rates are high right now, but you take a adjustable rate mortgage or an adjustable rate loan, which means that when the rates go down in the future, then your interest rate will go down. So your rate will adjust. So this is, and then after this became very popular. So essentially it's like a adjustable or floating rate, but this innovation happened in the 80s in response to the economic environment, which was that interest rates are very high. So this is one example. Another example is how technology influences innovation. You might, I don't know if you are aware of this or not, but in the 60s and 70s, do you think credit cards were all over the place? No. So one of the things that has enabled such wide usage of credit cards around the world now is technology, more specifically low cost of computing. To use a credit card, can you imagine how much technology and processing needs to go on? If there are, 200 million credit cards in the US, those credit cards are being used on average, let's say 2-3 times a day. To really make the credit card business work, you need to keep track of all those transactions, and vendors need to be paid, and so on and so forth. Now, only with low cost technology, which happened over the last couple of decades, was it physically or technologically possible to deal with credit cards. So when the technology became cheap enough to handle all this processing, that allowed the widespread usage of credit cards. So from an exam point of view, what do you need to know? You need to know that one of the influences of financial innovation is technology. Another simple example from our world right now is, even in Pakistan, over the last 3-4 years, the spread of e-banking or internet banking has been very high, right? So is this good for banks? Yeah, it really helps cut their costs, right? Rather than me every time calling my bank to figure out what my balance is or whether a check has cleared or so on. Is that costly for the bank? Yes, it is, because they need to have somebody at the other end. When they make it available on the internet, which one of these 2 points is happening? One or two? Yeah, basically they are lowering the cost of operations, cost of deposit. So that's another example. And then sometimes regulation also has an impact on what's going on. There can be numerous examples. I'm just using the one from the curriculum. You don't really need to know the exact regulation. You just need to know that regulation also has an impact on financial innovation. So in the past, there was this regulation called Regulation Q, which prevented paying interest on checking deposits. So this has changed. But anyway, in response to this regulation, then banks started introducing savings accounts where people would get a return, plus people could write checks against their savings accounts. So anyway, just example of how even a regulation can impact financial innovation. So what's the bottom line from this slide? 2-3 bottom lines actually. You need to know what financial innovation is. What is financial innovation? So simply developing new financial products. What's the objective? That's point number 2. Increase profitability, either by increasing the top line or cutting your costs. And then what is it that influences financial innovation? There you need to know the 3 points: economic, technological, and regulation. So those are the 3 sorts of things. So if you know this, then from an exam perspective, you know the main points. Okay. What are the effects of innovation and deregulation? Does everybody know what deregulation means? Now, just to give you a slight context here, at least in the banking industry and in the Western world, a lot of this reading is somewhat dated. What you are reading is, material that was written a few years ago. And as part of your general knowledge here, in the US, over the last 10 to 15 years, there's been a lot of deregulation in the financial industry. So banks that were not allowed to do stuff like, say, investment banking and so on, because of deregulation, banks were allowed to become bigger. They were allowed to broaden their product services and so on. But then 2008 financial crisis happened. And this whole long series of deregulation is now moving in the other direction. So like most things in life, even this regulation and deregulation goes in cycles. So there were people who believed that banks will regulate themselves and therefore the government needs to cut down regulation. But that turned out to be problematic, as was observed with the 2008 financial crisis. And now, this reading is a little bit dated in the sense that now what is happening is that the pace of regulation, actually now more regulation is coming back. But this reading was still written, and you are responsible for this reading, was written at a time when lots of deregulation was happening. So anyway, effects of innovation and deregulation: improved technology and repeal of ban on nationwide banks have led to larger banks and consolidation. This actually is still happening. In the past, in the US, every state had to have its own registered bank. So that has changed now, where now the US government allowed banks to consolidate and form banks across the country. So certain banks like Wells Fargo and Bank of America and Citibank became very large, and smaller regional banks have been shrinking. Deregulation of thrifts and innovations has led to the shift of funds from commercial banks to thrifts. So in essence, what has been happening is that the thrifts that I mentioned earlier are becoming more and more like regular banks. Innovation has also led to a shift of funds, or M2, from bank savings to time deposits and money markets. And you might see some of this here in Pakistan also, where over the last few years, money that might have been sitting in a regular saving account is now also moving into money market funds. So at a personal level, what I recently did was I had some money sitting in in my savings account. I took that out of my savings account and put it in that same bank's mutual fund. Okay, so these things are happening in the industry.